Micron stock is up nearly 300% this year, and management has guided for an 81% gross margin. That sounds extremely bullish, but the real question is not whether Micron can hit 81%. It is whether 81% is the start of a new AI memory era or the top of the cycle. Because Micron can beat earnings this week and the stock can still fall. In the next 10 minutes, we will answer three questions. What are investors actually buying when they buy Micron? Which numbers matter more than headline EPS? And for a long-term investor, is this a buy before earnings, a stock to wait on, or a risk to avoid? Stay to the end because the answer depends on what Micron says about the quarter after this one. As this video is recorded, Micron reports fiscal third quarter earnings on Wednesday, June 24th after the US market closes. The last quarter was exceptional. Revenue came in at $23.86 billion, up 196% from a year earlier. Adjusted earnings were $12.20 per share. Adjusted free cash flow was $6.9 billion. Then, management raised the bar again, $33.5 billion in next quarter revenue, adjusted EPS near $19.15, and an 81% gross margin. Micron expects to keep roughly $81 in gross profit from every $100 of revenue before operating expenses. Wall Street has known this target since March, and Micron shares were up about 298% year-to-date as of June 19th. So the stock is not being judged against the past. It is being judged against a very high expectation for the future. Micron already showed why that matters. In March, the company beat expectations and guided revenue above Wall Street's estimate. Yet the stock fell about 5% after hours, after management increased its capital spending plan. The lesson is simple. A strong report is not enough. Micron has to be stronger than the expectations already priced into the stock. Micron does not make the AI processors that get most of the headlines. It makes the memory and storage those processors need. Its core products include DRAM, NAND flash, high bandwidth memory or HBM, and data center solid-state drives. Think of an AI server this way. The GPU is the engine. Memory is the workspace that keeps the engine from waiting for data. That is why memory has become strategically important in the AI buildout. But Micron is not a software company with stable subscription margins. It operates in a cyclical industry. When demand is strong and supply is tight, memory prices rise and margins can expand fast. When supply catches up or customers slow orders, those prices can fall fast too. The latest quarter was broad-based. Cloud memory and mobile and client each produced about $7.7 billion of revenue. Core data center contributed $5.7 billion. Automotive and embedded added about $2.7 billion. That diversification is a strength, but tight supply and stronger memory pricing were the common drivers. Micron has also begun volume shipments of HBM4 for NVIDIA's Vera Rubin platform. That matters, but HBM is not the whole story. The stock needs strong server DRAM, strong data center NAND, and firm pricing across the industry. Now here are the three numbers that matter most. Number 1. Gross margin. Micron's last reported non-GAAP gross margin was 74.9%. Management guided to about 81%. That is the headline number everyone will watch. A margin that high says supply is tight, pricing is favorable, and Micron is selling a better product mix. But it does not prove that the margin is sustainable. The key question is not, did Micron hit 81%? It is, what does Micron guide for gross margin in the next quarter? If the next guide is higher or at least stable with strong demand, the AI memory thesis gets stronger. If the guide turns lower, investors may decide that 81% was the peak. Number 2. Data center demand and pricing. Core data center revenue jumped from about $2.4 billion in the prior quarter to $5.7 billion in the latest one. On the earnings call, listen for words such as allocation, supply, pricing,
HBM yields, and customer demand. Those words will tell you more than headline EPS. The bullish message is clear. Demand is still ahead of supply. HBM production is ramping well, and pricing remains firm into the next quarter. Number 3. Capital spending versus free cash flow. Micron generated $6.9 billion in adjusted free cash flow last quarter, but it also plans to spend more than $25 billion in capital expenditures in fiscal year 2026, with spending set to rise again in 2027. That investment is necessary if AI demand remains strong. But in memory, today's shortage can become tomorrow's oversupply. So do not only ask, can Micron build more capacity? Ask, will that capacity earn attractive returns when the cycle changes? Micron is competing with Samsung and SK hynix, the other major suppliers of HBM. Samsung brings enormous manufacturing scale and a diversified business. SK hynix is a leading HBM supplier with deep AI server exposure. Micron offers focused memory exposure, a US listing, and progress in advanced DRAM and HBM. But this is not a winner-take-all market. The more important comparison is this: which company can protect pricing, execution, and margins as capacity expands? All three benefit from AI demand. All three are investing heavily to serve it. That is why Micron's report matters beyond Micron. It's a read-through for the entire AI infrastructure trade. If Micron sees demand accelerating and supply staying tight, it supports the idea that hyperscaler spending is still reaching the physical infrastructure layer. If pricing softens or orders weaken, the market may question whether the AI spending cycle is maturing faster than investors expect.
Here is the bull case. First, AI is creating a real increase in memory content. AI servers require much more high-performance memory than traditional servers. Micron says data center NAND revenue more than doubled sequentially in its last quarter, while server DRAM and HBM demand remained strong. Second, supply is still constrained. Micron expects DRAM and NAND supply-demand conditions to remain tight beyond calendar 2026. That is management's forecast, not a guarantee, but if it proves correct, memory pricing could stay healthier for longer than in a normal cycle. Third, Micron's growth is broader than one AI product. Cloud, data center, mobile, client, automotive, and embedded all contributed to the latest result. Fourth, Micron has cash and real free cash flow to fund expansion, ending the quarter with about $16.7 billion in cash, marketable investments, and restricted cash. The bull case is not simply that Micron will beat one quarter. The bull case is that AI has changed the value of memory. Supply stays tight, and today's high margins last longer than the market once believed possible. Now, the bear case. First, expectations. When a stock is up nearly 300% in less than 6 months, investors are not paying for average results. Micron could post excellent numbers and still fall if margins flatten, pricing commentary cools, or the next quarter outlook does not move higher. Second, cyclicality. Memory pricing is powerful on the way up, but it can reverse quickly. That is the nature of this industry. Third, capital spending. Micron's $25 billion plan is bullish for growth, but every major supplier sees the same AI opportunity. If capacity rises faster than demand, the profit cycle can turn. Fourth, not every end market is equally strong. Supply constraints could pressure PC and smartphone unit volumes, leaving data center demand to carry more of the story. And the final risk is valuation. Micron may be executing very well. That does not mean every price is a good entry point. A great company and a great stock are not always the same thing. For a retirement-focused investor, Micron is usually better viewed as a satellite holding, not the core of a portfolio. It can offer meaningful upside if the AI memory cycle remains strong, but its earnings and share price can be far more volatile than a diversified index fund or a mature dividend business. An investor with decades before retirement may tolerate more volatility. An investor closer to retirement should care more about position size, diversification, and timing risk. Also, check your indirect exposure.
You may already own Micron through a technology fund, a semiconductor fund, or a growth-oriented retirement account. Adding Micron directly may increase your exposure to the same AI data center cycle you already own elsewhere. So, buy, wait, or avoid. Before earnings, the cleanest answer is wait. Not because Micron is a bad business, because the market is asking for more than a beat. It is asking Micron to prove that 81% is not the peak. A bullish confirmation would look like this: gross margin guidance that holds or rises, clear evidence that DRAM, NAND, and HBM demand remain tight, strong data center pricing commentary, and capital spending that still leaves room for healthy free cash flow. A wait signal would be a strong quarter paired with a stock price surge before you understand the next quarter guide. An avoid signal would be lower margin guidance, softer pricing language, or rising capital spending without a convincing return story. The goal is to know what would confirm or break the thesis before the market reacts. Micron has become one of the clearest ways to invest in the AI memory buildout, but the stock did not rise nearly 300% because investors expect ordinary results. It rose because they expect demand, pricing, and margins to keep moving higher. That is why 81% matters, not as a finish line, as a test. Can Micron show that the margin can hold and a cycle can continue, or has the market already priced in the best part of the story? This is for education, not financial advice. Comment holds if you think Micron can sustain these margins, or peaks if you think the memory cycle is closer to a top.